Welcome back to the channel, everyone. My name is Anthony, and in this video, I'm going to teach you the fundamentals of wave theory so that you can learn how to read the market. So I'm looking to do a multi-part series going in depth into how to utilize wave theory to make money in the stock market. So if you would like me to make more videos on wave theory, please hit that like button, leave a comment, and subscribe if you haven't already done so. And I will continue to keep making these type of videos in the future. So this first video is going to teach you how to identify a simple wave and its components, along with recognizing its associated patterns and drawing out some price targets for each part of the wave. So to first start off, markets love to move in 5 wave structures, and this is called an impulse wave, which is what we'll be focusing on mainly in this video. So to draw your Elliott impulse wave right here, so you're going to go to, I'm using TradingView. I'm sure most plotting websites have this ability, and you just click on Elliott Impulse Wave and you start off here. So we're just going to first draw a 1, 2, 3, 4, 5 structure. So I'm just going to arbitrarily put some targets here, the third wave, fourth wave, and the fifth wave. So right now I've marked how markets typically move if there's some, for example, some positive stimulus news or any type of good news for a stock. Markets will tend to move upwards in this pattern. So the first spike that happens in an impulsive wave is known as the first wave, depicted here. So we can see that after some positive news, like I said before, people are naturally going to bump up the stock price, and this is going to cause this increase that you see here. And because this is typically the first time that you see the stock price move in a substantial upwards motion for a decent time frame, there's naturally going to be people taking profit the higher you get. So, and this profit taking that results at the top of wave 1 starts this downward move to form wave 2. And typically wave 2 retraces a lot of the price action from wave 1. So to calculate how much wave 2 will retrace of the upwards motion of wave 1, we're going to go to this tool, and in TradingView, this is where it's located. It's the third down toolbar, and we see the tool called Fib Retracement, and we're going to click on this, and we're going to click on the bottom or the start of wave 1, and we're going to drag it up to the top of wave 1, and we get these levels right here, and we're going to click. And so using this tool grants us all these possible retracement levels, and typically because wave 2 is such a harsh retracement of the first wave, we're going to get around these levels of retracement. So in other words, these levels, so the 0.618, the 0.786, and even the 0.886 just means that wave 2 will retrace 61.8% of wave 1, or 78.6% of wave 1, or even 88.6% of wave 1. So now that's how you determine where wave 2 will land. And once you approach these areas, this is a good buying zone. These are all good buying opportunities in this blue rectangle here to try to capture the meat of wave 3. So now we move on to wave 3. And the way you predict wave 3, which is the biggest movement of the wave typically. So think of wave 3 as the main meat of the impulsive wave. And to predict the movement, we're going to go to trend-based fib extension, which lies right under fib retracement. And we're going to click on the bottom of wave 1 to the top of wave 1. And now we're going to drag it to the bottom of wave 2. And we get these levels right here. And so we see that wave 3 actually happened to land right at the 1.618 level. And so now these target zones, so 1.618 and 1.414, are very high probability targets where wave 3 will land. And there's also, if you scroll upwards here, there are still these higher targets, so the 2.618, even the 3.618. But for now, for most trading, we'll focus on these levels. And this just means that wave 3 will typically be 1.618 times the length of wave 1. And so these levels are good areas to take profit. In addition, you could also take profits at the 1-to-1 ratio, which means that's the area or the price level where wave 3 has gained equality with the length of wave 1. So that just means that wave 3 went up as far as wave 1 traveled. So if we were to roughly show the projection of this wave so far, we would kind of see this upwards motion for wave 1, this harsh retracement for wave 2, and then expect wave 3 to have some trouble getting through this 1-to-1 level. So we kind of see some kind of pullback here, and then a push further upwards into these levels. So that's just a rough drawing. Obviously, this is not like how it usually works, but what I'm trying to say is expect some kind of pullback from this one-to-one level. And that presents another buying opportunity for you to get into this further move upwards for wave 3. So now that we've identified our wave 3 targets, we're going to identify our wave 4 targets. So to do this, let me get rid of all of these tools. We're going to go back to our Fib retracement. And what we're going to do is click the bottom of wave 2 and drag it up to the top of wave 3. And as you can see here, our wave 4 happened to match some pretty accurate price targets as well. So wave 4 does not retrace as much as wave 2 does. And typically we see around, I would say, these areas the most. Typically, actually, you would kind of go down to here. So these levels are very good buying levels to get into wave 5. And specifically, you typically see wave 4 retrace around 38.2% of wave 3, or half of wave 3, or even 61.8% of wave 3. However, the key point is that wave 4 does not retrace as much as wave 2, because wave 4 is more of a shallow retracement. And I'll get into some patterns that are very commonly seen in wave 4s versus wave 2s, so it can help you identify where you are in a wave in an actual stock price movement. So now that we've identified a landing area for wave 4, let's go to wave 5 now. So to do this, we're going to go back to our trend-based Fib extension tool, and we're going to use the length of wave 1 to estimate the length of wave 5. So we click on the bottom of wave 1 to the top of wave 1, and instead of going to the bottom of wave 2, we're now going to drag it over to the bottom of wave 4. And we can see here, wave 5 typically gains equality with the length of wave 1, but in some cases it can go up to these levels, especially if the wave is extended, in which I will cover those details in a future video if you guys want me to. Because these are the basics of wave theory, and there's a lot of intricacies and complexities that come with the theory that are pretty important to cover. But for now, typically wave 5s will land around these areas. So I will mark that with a box. So wave 5s can land typically anywhere here. And what you do with wave 5s, if you want to project a conservative price target, is to do this. So you take a box, and you simply draw a box around the height of wave 1. And all you do, so let me get rid of these tools, or actually I'll keep that, and I'll show you what I mean. So we drag this rectangle right here to wave 4, and this shows you the one-to-one retracement level. So at these levels, you would mark it here, and you would set this level as a price target. So if you were trying to get in on the wave 5 by buying in at the bottom of wave 4, you would typically sell some of your position at this one-to-one ratio. And that just means this is the point where wave 5, the length of wave 5, has gained equality with the length of wave 1. So now I just want to overview some of the basic rules that come along with wave theory. And for now, I just want to introduce 3 main things. All you need to know is that wave 3 cannot be the shortest wave, so this means that wave 3 will not look like this. If you have a wave 3 that looks like this, which means that it's smaller than wave 1, for example, you don't have a valid wave, and this would not be counted as an impulsive wave. The next rule is that wave 4 cannot cross into wave 1 territory, so that simply means that your wave 4 cannot go down here. It has to stay above this line. And so you would expect this line to be heavy support for the wave 4. And lastly, wave 2 cannot go below the start of wave 1, and that just means wave 2 cannot look like this. If you see a movement in the stock price that just has an upwards move and then a downwards move that goes beyond this starting point, you have invalidated your wave count and you no longer have an impulsive move. And so those are just 3 basic rules that just keep in mind. And these are some things that summarize what tools you should use to estimate price targets. And so now a big thing about wave theory is pattern recognition. So the best way to recognize where you are within a wave is to see whether you are in a second wave or a fourth wave. So it's really important to know what these price movements look like. So we're going to go over here. So I drew out some of the very common patterns that you see in each type of wave. So we'll start off with wave 2s because they're very simple. And like I said previously, wave 2s are very harsh retracements, and they tend to correct a lot of the percentage of the wave 1 increase, such as 61.8% or 88.6%. So In wave 2s, we have zigzag corrections, which just means a simple A, B, C move downwards. And you can actually subdivide the ABC waves into a 5-wave move to the downside, a 3-wave move to the upside, and then another 5-wave move down to finish off the ABC correction. So that's wave 2s, that's what they'll look like. Now, in contrast, we go to wave 4s, and there's a lot of patterns that can appear, but these are some of the most common ones. There's also something called flat corrections, which I will cover in a future video, another wave theory video, if you guys would like me to, and let me know in the comments down below if that's something you would like me to do. But for now, these are the simplest ones and the ones that are most relevant to trading wave theory. So first of all, we have ascending triangle, where price bounces back and forth between two trend lines. And in this case, your top trend line is just staying flat, while the bottom trend line is slowly increasing. And when you have this kind of movement, price movement, you'll see each kind of waves, this A wave, for example, subdivide into 3 waves. And so you have an A wave, a B wave, a C wave, a D wave, and then an E wave, and then a push upwards for the 5th wave. And typically, if you're trading triangle patterns for any of these patterns, you want to buy in on these bottom waves. So for example, you would want to buy in on the C wave or possibly even the E wave. Another way to trade is to wait for this breakout, and once it breaks out, then you get into the position and cash in on the wave 5. So now we're moving on to the descending triangle pattern. It's basically the same as the ascending triangle, except the bottom trend line stays flat while the top trend line slowly collapses on the price. And this kind of forces price to move upwards if it's going to make that 5th wave price movement. And so those are triangles, and now we have channels. Channels are typically 5-wave structures within a wave 4 that bounce back and forth between 2 parallel lines. And I will show you some examples of this in action with some actual stock prices. And for instance, for these patterns, I've shown you 5 structures, so A, B, C, D, E. These can typically also be ABC patterns, as shown here. So this introduces the descending channel, which is just an ascending channel, except the parallel lines are moving downwards. And for this example, I showed how these channels can also be ABC movements, which means that the price simply touches the trend lines. So this could look like this if I were to draw this. So let me try drawing this for you. So we take our drawing tool over here, and we go upwards, and we kind of bounce 1, 2, 3 times, and then we push upwards. So the amount of times you bounce back and forth between these channels typically means that you'll have a stronger wave 5. The longer your price stays within these consolidation patterns, the stronger your breakout move will be. And finally, our last common pattern will be a pennant. And a pennant just means 2 trend lines that are both increasing and decreasing on each other, which form this kind of sideways V-like structure or a flag pattern. And price will bounce back and forth between these trend lines, and you can buy in on the C wave and the E wave bottoms, and then cash in on this upwards move. So those are just major common patterns that you see in wave 4s and wave 2s. So that's all the major patterns that you need to know for basic fundamental wave theory. And if you guys would like, I can cover some specific examples of wave theory in action in specific stock prices. And please let me know in the comments if you'd like me to do that and continue this series. And also be sure to subscribe and leave a like to let me know if I should be continuing these series. So that's going to be it for this video, and I'll see you in the next one.